Howdy, Jacob here. Today we're looking at NetEase Company, 87 of our high ROIC screener, 68 billion market cap on 51 billion enterprise value. So net debt is pretty substantially negative, meaning they have a lot more cash on hand than debt. They are in the online games, music streaming, online intelligent learning service, and internet content in China and internationally. So pretty big market capitalization for being founded in 1997. Okay, been around quite a bit. Crazy to say that that's actually around quite a bit. Interesting. But revenue is outstanding, where it's actually lagged pretty substantially post COVID. But pre COVID, you were looking at probably 20% CAGR over the 7 year period from 2014 to 2020. But last 3 years has definitely been down quite a bit. Return on invested capital is still substantial. Gross margin down from 10 years ago, but has been increasing pretty heavily since 2019. And operating margin, again, down pretty heavily from 10 years ago, but still in the realm of reasonability of 27%. That's still pretty substantial. They've been paying a dividend for a while now, and it's grown also substantially. Balance sheet shows 17 million cash on hand with short-term investments and 2.7 billion in short-term debt, essentially no long-term debt. So they have the cash on hand right now to pay off that short-term debt. So no concern, no concern from a balance sheet perspective, and they produce an extensive amount of cash flow. Free cash flow has over 5 times from cash from operations. And although their capital expenditures have grown 4 times. So their free cash flow has been gushing out with a lot of use of reinvestment. So they are very good at reinvesting back into themselves. And as you can see, they've historically gotten a pretty good rate of return on those investments. And then for other use of cash, their share repurchases of the rolling 12 is maybe 25% of their 5 year average free cash flow, maybe 20% of their 5 year average free cash flow. Their dividend is paying out probably 25, 30% of their 5 year average, and then they bought back quite a bit of debt. But heavy amount of reinvestment. I love to see that with great returns. You're seeing mid to high double digit, or sorry, not mid to high double digit, mid to high teens on the return on invested capital side. So they have gotten great returns historically, and let's hope that they do it. They keep doing that. But with the assumptions, let's get to it. Revenue growth, I think it's slowed down quite a lot recently to where it might be a little bit more conservative than others, maybe 5% revenue growth. I still don't think they've capped out the business, and I think that China still has a very substantial amount of growth ahead of them. I think that with them reinvesting so heavily into themselves, I'll put a bit of a premium on it. But again, I'm putting a slightly less premium than I would for an American company due to the fact that it is a Chinese based company. So keep that in mind. I think if this were an American company showing these numbers, I'd probably push along 18 even with that smaller revenue growth. Not saying that's absolutely a substantial difference, but just wanted to point that out. Maybe even I'll go 16, saying that I'll put a premium over the market due to the fact that I think that they have growth maybe in excess of the market with higher return on invested capital, but I'm a little skeptical of their location. Um, not I'm nothing against China. It's just the way the market is. They have at least right now and for the last couple of years have definitely put a hinder on the price to earnings and free cash flow valuations of even some of the best companies like Alibaba and Tencent selling for mid single digit or high single digit, low double digit for companies that in America are currently selling for 30 or so P. Not saying it's going to be how it is in the future. I don't think personally that Baba should have a 8P 7 years from now if they have been growing and have growth in excess of inflation. So, but just pointing that out. So revenue or earnings margin, free cash flow margin. I love that free cash flow has been historically quite a bit higher. Maybe I'll do 22%, 25%. And then let's say that 1% of shares is about 700 million. I think that seems reasonable to me. Their dividend, they can absolutely afford that. It's about 25-30% of their free cash flow. So what have they done historically? I don't increase it too much. I'll increase it with their revenue growth. I think that's reasonable. And yeah, we just get to a price that is needs to drop 46% before you get a 15% return with these assumptions. I think it's a great company. I think that some people just have problems with businesses that pertain in China, and sometimes it's difficult to fully have trust in the business's numbers and such. But based on how large the capitalization is, and I'm sure if I were to look through it, they are probably filing through, um, some company with their 20F, whether that be PwC or Deloitte or another accounting firm. So I think that the numbers are reliable here. I presume. Don't quote me on that. I haven't even done the research on the in-depth analysis, but I do think based on the numbers that I'm seeing here, it is a fantastic company and one that I want to own. But again, everything is the present value of earning and free cash flow, and I think that is just slightly elevated right now. Hopefully you enjoy the video and have a great rest of your day. Thank you.